Hello everyone, it's me, the Boss Hog. We're back for a second video in a week, which I know might be very surprising, but we're trying to do better. And I thought we'd do an update on how we're doing building our wealth as of the end of August. Let's do it. Alright, so I thought we're better to begin than our wealth targets. It's been many months since we talked about this, so just as a quick reminder, the most important target for this year is to add 70k to our investments. This is really the most important financial target because we're fully in control of it ultimately. All of our other wealth is either exposed to the stock market or the housing market, both of which there's only so much control we can have over. But this one is fully within our remit, so it's the most important and should keep us nice and focused. And then secondly, the main target here is for me to retire at 55. I'm 36 currently, just turned. So this is basically 19 years into the future with 5 million in wealth. And that covers both my wife and I. I do, for transparency, include basically the Boss Hog's family finances are basically here. So I plan to still be married to my wife in 19 years. Obviously, a divorce would massively destroy my target and we'd have to revisit things. But it's definitely not, at least on my time horizon, to get divorced, and hopefully not in my wife's plan either. So full transparency, that is the target. That target is broken down into sort of 10 bite-sized targets along the way. We'll touch on them later in this video, which I have revamped for this video. Let me know if you want different details or different perspectives or etc. Feedback's always welcome. So yeah, those are the big two targets basically. Let's delve into details. Alright, so in terms of progress for 2023, I thought this was the best way of presenting it. I have this data for basically 2023 when I started reporting it in this way. So basically I'm going back every 3 months, and in the future I'll do like a rolling year with 4 previous periods once every 3 months, as well as the current. Right now I can only go back basically 9 months, 3 quarters. So this is what we're currently dealt with. So that's why we're only showing 3 here. I've also done here a 2023 to date, so that includes everything up until the end of September, and then a projection if we carry on in a reasonable way. So I think we're running solidly ahead of schedule. I just mentioned that 70k is the plan for this year. I'm targeting currently 78k. There's a couple of reasons for this relative outperformance. My wife especially has seen quite a rapid increase in her salary over the last year. She's also hoping for a bit more just because she's been a bit of a winner across 2 reorgs within her company, and apparently she's doing really well since joining a year ago. So that's awesome basically, and we hope for a bit more positive news next year when she's hoping for a formal promotion. We will see. I also had not immaterial pay rise as well about a year ago. So some of that, my pay rise especially, was factored into this, but my wife's wasn't, so that's been very helpful. The other thing as well that's probably worth calling out is we have focused on reducing costs this year. To be honest, although we're in a pretty fortunate situation compared to many, we've really noticed the increase in food costs in particular, where we were running at like £750 a month for a family of 3. We've drastically reduced that to more like 400 now. That's been really targeted and not always super easy. But that feels really good, sort of seeing that borne out in these. We've also done a few things like cancelled off some insurances or subscriptions that we didn't need, and kind of revisited a lot of our costs, and feel a lot better for it. Honestly, we did a bit of a trim, and actually it's sort of saving us. If you combine the sort of 350 from shopping plus those subscriptions that we've cancelled, it's the better part of £500 a month. So those 2 things combined have really made a noticeable difference on our costs and sort of balance at the end of the month. I haven't added to the no ISA for 3 months, but we did get a little bit ahead of what was always going to be an expensive summer. We had sort of half-year quarterly bills for our home. We also did a remortgage, including remortgaging fees, and I sort of had to work through that process. And 1 or 2 other costs as well that we were sort of expecting, but were still pretty nasty all the same. The last one, I've just finished paying off my daughter's school fees, which are now quarterly or termly actually, instead of monthly how I was paying before. So that's the last final big bill that we were expecting. Now we're sort of hopefully returned to relative normality. And although, I mean, in fairness, I'm now 2 months ahead on my school fees for my daughter, right, as a result of having to pay in advance. So actually, toward the end of this month, things should start to be better, and we're planning on still hitting our 40 grand target for both of our ISAs, is still the hope. You can see here, actually, I've got a slight underperformance on my wife, but I'm hoping that between my wife and me, especially because we both have bonuses due, that we'll be able to make up that little bit of a shortfall there. And my projection is probably too high. I suspect we're always moving money around in late March. I've sort of made that go a bit higher than it should do. Obviously, for anyone who's not familiar, you can only put 20 grand a year into an ISA, so I probably need to refine that projection just a little bit. But we still are targeting 40k total into both ISAs. Yeah, that's still the plan. And we'll be seeing more of that. But for now, I'm super happy with the direction of travel. By the way, for anyone who didn't watch my weekly video, the reason why it's red on my wife's pension contribution is because her employer didn't pay in the pension contribution for August. My wife has inquired, and literally today they advised that there was an issue when they moved payment provider. Basically, it took a lot longer to get set up than they were originally expecting, and it should catch up by the end of this week. So at the moment, we're a little over £800 behind where we should be because of that mistake or that delay. But hopefully, again, that should fix itself. And at least, you know, again, they've admitted there's a problem, but there's nothing more untoward than that, should we say. So, yeah, so far so good in terms of progress for 2023. All right, so in terms of how the wealth is looking overall, this is how it's looking currently. A similar story to beforehand. We're doing every 3 months here, and we'll add a fourth one as I have the data to do so. I introduced a couple of breakdowns that weren't previously here, just following some chats with people in Discord. So type of wealth being liquid or illiquid, non-liquid here, and then asset classes as well. So again, I do expect in the short term to have sort of 3 main parts: ISA, home, and pension, broadly speaking, evenly. However, with the interest rates being what they are now, I do wonder if we'll pay a little bit more into our home equity and basically overpay on our mortgage. We've been doing that now for about 6 months. It makes my wife really happy. And you know, since I was doing these plans in the past, where I expected to have by retirement about 50% in ISAs, 40% in pensions, and 10% in home equity, that may well change slightly, just because, you know, I've had those conversations with wifey, and we've kind of agreed at this point that once we do ISAs maximized, full pension matches, the next big target now makes sense to be mortgage, just because our mortgage rate has gone up from, you know, 1.2% to like 5%. So although it's arguably still better to put it into investments, it makes my wife super happy. She's contributing more to our earnings than ever. And, you know, probably next year we'll have more or less a 50-50 split in terms of our take home. So I think at that point, right, I should be considering her wishes. So I think the sort of any delta between the mortgage and the investments, it's justified. In the past it wasn't, but now I think it very much is. So again, we might put a bit more focus into overpaying. My wife also suggested that if we overpay and build up enough equity, you know, we might be able to get second place. Again, that was kind of quite new, but something I'd definitely consider. But isn't in these numbers or my long-term plans. It will definitely be a change in focus, but again, it's 20 years, and I think it's important to stay flexible, especially when you're building this plan with somebody else, right? So yeah, so the other thing worth mentioning here is my home equity. When I remortgaged, my home was actually revalued, so I had a 487,500 price tag put on it. That was actually a few thousand higher than my 2% run rate growth, so I think 2% is defensible. That kind of proved it. I do live in London, but I live in one of the cheaper areas of London with the most room to grow. A lot of the London house prices are kind of dominated by central and west London, where the prices are pretty extraordinary, even by London standards. So again, I think here the 2% growth in my borough year on year is quite reasonable, and if anything, slightly prudent. But we'll crystallize it periodically when we do a review, and all that this does is basically takes the 487,500, adds the equivalent of 2% on a monthly basis, and then reduces my, you know, basically takes off my mortgage owing, and that's basically what you're looking at there in terms of home equity. So that's the way that works basically. So yeah, so that's how it's looking at the moment. Again, do expect to miss that target, but again, it's a long-term target based on 8%. At the moment, we haven't really seen that as an average, certainly over the last couple of years. So although it's looking better this year, it's still slightly behind that long-term average. That's how it is at the moment. All right, just a breakdown of those targets. I've slightly reordered these since I shared again many months ago, but the table on the left there, those are basically the milestones, and they're rounded to the nearest month where I exceed it. So 503 technically, which is the first month where I'm due to exceed 500. Again, expect to miss that, but we will hit it hopefully as soon as possible. It's interesting because my first target I actually beat by almost 2 months, right? These figures at the end of each month. So again, we have 401 at the end of August. We will be adding about 35k between now and the end of January, but even still, right, even if we round that up to like 440, it's going to be a fairly significant shortfall. So current run rates, we're due to hit it sort of May, so sort of 3 months to 4 months overdue. But again, we'll just carry on plodding and see if we can catch up in later years when hopefully the market, or the housing market, or the stock market is a bit nicer. I would also actually add that when I calculated my very long-term plan, I took my wife and my current salary at that moment in time. Since then, again, we've both had, I've had like a 15% pay rise. My wife is on a 50% pay rise. And I also didn't factor in bonuses. So I'm hoping, it's pretty prudent, although it wasn't, there was always an assumption that we would be earning at least as much. My wife and I are pretty career driven and kind of probably in the peak of our careers at the moment, so I think it's at least defensible to take that position, especially when there was a lot of assumptions not built in, like continuous pay rises, bonuses, etc. So there's definitely an opportunity here in later years for kind of overpayments and things like that, but we will see. And then the numbers on the right here are actually stuff I put in. I mean, this is almost 3-year-old as a target now when I first started doing this. So I did reorder this a little bit because originally I had a lot of the dividend targets being hit before my wealth targets, because I started off at like over 4% as my projection. And in fact, what my portfolio was in the early days, it was very defensive, utilities driven, reach driven as well, and was basically a bit more income focused than it is today, where my dividend is like 1.8%. So actually, my dividend yield certainly is down. As a result. So I've reordered this a little bit to kind of separate out the wealth and the earnings targets. Have completed a couple. You can see the 250 and the 100k in ISAs. They're about 140k at the moment in our ISAs. Yeah, and then basically everything else has percentage targets. So we're almost there in terms of the three grand in a single year. Actually, I think we're going to meet that in either this month or next month. I've converted this to a rolling year because I think it's a little bit more accurate and more timely. And you can see here, or you might not be able to see, but there's a little bit of shading. So I've made it sort of shaded green if we're above 80%, so we can get excited as we near the target. And then obviously very green if we've completed anything. So again, these are my very long-term goals. Really, in terms of the 100k in dividend in a single year, like that will basically be when we retire, when I will restructure our holdings and convert them into more of like a 4% dividend yield. So again, the long-term plan here is to have 2.5 million in investments by the time we retire, almost all of which should be in our ISAs, so that will be tax-free income. And so 100k, 4% a year, tax-free is a significant amount of money to be earning. It's the earning power of about 180,000 in salary, so it's a massive, great lifestyle from my perspective. So that should be awesome. So yeah, we'll keep this updated, and we do, and I don't see any need at this moment to introduce additional targets. I think these are good, and they cover sort of both capital adds and investment performance basically over a very long period of time. So happy with how these are shaping out, even again if we are going to miss our next milestone target by the end of January. All right, so this is new. Although I sort of mentioned periodically in my ISA portfolio performance, sort of what my profit is, and you can infer what my capital add is. Actually, I've never done this before, where I've broken it out into periods of sort of capital added. You'll also see here a secondary column of transferred and withdrawn. I might remove the first two columns and just do the net position in the future. That's typically what I show on the weekly performance. But actually, I did think it was important, at least for now, to show both, because in the early days when I started, I mean, 2020 here really only covers about 6 weeks. My wife was on maternity leave during 2020. We built up quite a lot of cash just in case, the worst happened, or she decided not to go back to work for any reason. So when we started, we didn't really start small like a lot of people. We went in with, like 40 grand almost immediately. So that was that. And then, in 2020 and part of 2021, I was transferring money between my general investment accounts and my ISA accounts. It wasn't until sort of several months into 2021 that I realized that basically when I withdrew money or transferred money out of my ISA into my general investment, basically that reduced the amount that I could add into my ISA by whatever figure I transferred out. So actually I was kind of doing myself a disservice by like reducing the maximum I could then add in the same tax year. Some ISAs do allow you to sort of move money out in the same tax year, but my one doesn't. And so when I found out, I was like, and stopped doing it. But that's why the 2020 and 2021 there is so significant. You'll also see that like the previous in 2022 and then February 23, those are basically linked to end of the financial year moves where I was kind of maxing out stuff and transferring it deliberately from my general investment account into my ISAs to make sure I hit my 40 grand a year. And then in June, you can kind of see June, July there. I did it basically on the last day, so it looks slightly funny where I sort of withdrew money from my investment account again and put it into my ISA. And a very similar thing happened in August, but didn't have the cross-month period. What that's really looking at is where I've reduced my exposure to Games Workshop. So in the past, I was using my general investment account basically as a savings account. That's not really what you should be doing, right? And currently we've basically been building our cash. I think we're up to about 12k at the moment. We probably need a bit more, to be honest, but our emergency fund is now saved in cash and basically offset against our mortgage, so that reduces our mortgage payments, which is nice. And that's basically the approach that we've been taking. So where I've been selling down my Games Workshop, which was like a proxy emergency fund, which shouldn't be using. Also, as well, by selling down Games Workshop, I was making sure I stayed below the dividend tax threshold. I don't want to be filing tax or taking, a 40% hit because I'm a higher rate taxpayer. So again, I'm making sure I stay below that. So that's kind of the reasons for some of those historic movements. Yeah, in the future, I don't plan on doing that. It should just be going straight into my ISAs and not doing any further transfer, basically. Yeah, so whoopsie. There was one more thing as well. Oh yeah, there is one there that I kind of I glossed over, which was May 2023. I had a bit of a chat with my wife about dividends, and at first she was like, "Wow, you're getting dividends for just nothing." And I was like, "Well, yes, kind of." But it was that kind of whole skepticism, and I had to, like, my wife is also new to investing, just like I am. Comes from an ex-Soviet country where they have very low trust in institutions, shall we say, as a result. And so, my wife is sort of really doubts this until she sees cold hard cash, to use her sort of terminology. So when we got, actually, again, it was our Games Workshop dividend in the last quarter, it was worth 88.35, and I withdrew it actually into cash. So I took it out of my accounts entirely, and we went for a nice lunch and spent like, £100 on a nice lunch together in London. So it was like, I wanted to kind of show that there was real cash behind this, because, like, she's like, yes, it's great and everything, but we're not going to see it for 20 years. It's true, sure. So I thought it would be nice to kind of surprise her with this, and it did go down well, and my wife kind of had a bit of a laugh about it. So yeah, that 88.35 there has a story of its own. Good fun. And yeah, I do still have sort of 35 shares in Games Workshop. My general investment account sits at about 3.7k at the moment. Again, completely Games Workshop, so just take the Games Workshop share price and times it by 35, and you'll see that's what my balance is. For now, I'm not going to be selling any more Games Workshop. I think it's kind of fallen slightly below what I would think of as fair value. I sold a lot of my stake at like 115, slightly above, which I think is fair price. And SMT looked and still kind of looks really cheap to me. But my plan moving forward will just to be, to enjoy the Games Workshop position I have, because I'm still really bullish on it long term, and to add new capital and then buy SMT and a few other things from it. So I don't expect to be doing any more material transfers probably in the future at all. But that's kind of brings us up to date. And then that 130k then net, that reconciles fully with my position. So I think that's all explained. It's new, but if there's any questions there, feel free to ask. And so then, just before we wrap up in terms of my plan moving forward, I also thought it was worth adding this. Again, I do regularly talk about dividends, but maybe not in this kind of detail or view. This is all the dividends I've ever received. So this 6,900, give or take, matches with what I present on a weekly basis at the moment. And this is, by year and then by month for the last 12 months. And then for the last month broken down into what it was. August 23 was really a low month. Now, as I've already touched on, my approach toward investing has changed. When I first started, almost for arbitrary reasons, I read up and understood that the long-term average of the stock market was like 8%. And so I was focused on 4% capital growth and 4% dividend growth. And that was basically a pretty arbitrary approach, but it was all I had at the time as a relative newbie. Since then, I've sort of changed my focus. It's a lot more technology focused, my portfolio at the moment. And as a result of that, and also as well, I've been buying a lot more early stage and smaller companies, not tiny, but a lot of my companies are kind of between 500 million and sort of 5 billion in terms of their market cap. So definitely on the small to medium side, certainly, and not the kind of massive behemoths that I was dealing with before. And a combination of those two sort of sector movements as well as company maturity I've more than halved my dividend yield since I started. So even though I've massively added to my shares over time, um, you haven't seen the kind of share price growth that you might have expected to see, even though I've been adding a lot of capital over that time period. I'll also just add that you would have seen on my capital added that it started in 2020. I basically didn't have shares long enough to get any dividends before January 2021, so hence why that starts. I guess in fairness here, I could put previous 2020. There's no point. So yeah, this is my full dividend history. There's nothing omitted in any way. This is the truth, and is the reason basically for that mismatch. And again, as I touched on previously, you know, a lot of people, they start with a few £100 potentially, maybe even smaller, and so they see that kind of long-term compounding. You won't see that with me. You know, again, I started with a pretty big bang, and if anything, I've reduced my dividend yield as a result. So, you know, you can see an immediate reduction there in 2022. I will just about exceed my dividends for 2022 this year, but not by a ton. And again, that's despite the fact I've added, you know, the better part of 40 grand since then. So just to show you the impact of dividend yield into that. But I still really enjoy receiving dividends. Like even though I don't really focus myself as a dividend investor, like when I see like dividend raises from the likes of Amcor or Gamma. You know, Gamma today have a 14% dividend raise. Those are the kind of companies where I'm looking at long term in terms of dividend growth. So Gamma is sort of 11 to 15% every year as their policy. Amcor did a 50% quite recently. So again, thinking about the long term rather than the immediate dividend is my changed approach basically since I started. All right, so then I thought it would be good to talk about the work done and the work in progress over 2023. So first of all, a couple of things that are still in progress. I am in the process of moving my junior ISA, so this is the stuff for my daughter, from Nutmeg to Hargreaves Lansdown. I like Nutmeg, it's where my consolidated pensions sit and where my wife's consolidated pension sits, but the fact is that Hargreaves Lansdown have recently introduced 0% management fees for junior ISAs. You know, depending on the exact range that you take, you know, this basically saves her ultimately 1.6 to 2.5 grand across the next 15 years before she gets it. So to me, that's just too good of an opportunity to pass up. I did actually try to do it previously, but they wrote me a letter. The problem with Hargreaves Lansdown, I've discovered, is that everything's very old school, so you have to fill out stuff in writing. And basically, the account number I have has a 5 in it that looks like an S apparently when I fill it out. So they gave me a letter saying this is what we tried, and ultimately it didn't work because the account number is different because apparently I write like a doctor. So that's frustrating, and I will be contacting them very soon because again, I'd really like to progress with that for sure. This is quite a new one actually. So I was doing a bit of, I basically spoke to a financial advisor, one of the things I also wanted to do this year, and she was mentioning this. So this is the Enterprise Investment Scheme and the Venture Capital Trust, I guess. But these are sort of tax advantaged. I would call them high risk. I think that is what they are. But they have some really cool tax advantages where, like, as soon as I invest in them, I get a 30% rebate on my income tax, which is pretty huge. You know, and if they fail, then I can claim a further 40% reduction in capital loss. And if they succeed, then I pay no capital gains on them as long as I hold them for a number of years. So there's some interesting stuff here. Another factor that I have to consider is whether my wife's employer will allow me to do this stuff. Again, because she works in venture capital, there are lots of limitations that we have in terms of what I can buy and sell, so I need to also kick off that query. And I was actually looking into a venture capital trust by Octopus quite randomly. So many UK people will know Octopus because they're a utilities company here, but they interestingly have a £9 billion investment fund. And they actually do venture capital, but as a pooled investment, which is much lower risk, although much lower reward. But they basically, you know, you per every £25 that you invest, you basically get one share in Octopus investment, and then it's pooled like anything else. It's almost like an investment trust. But I thought this was a really cool approach, so I'm hoping that will be an acceptable way, and I've registered my interest at the moment. That's all very new to me. But when I discussed it with my wife, I wasn't sure how she was going to take it, and she was like, Liam, it sounds amazing. So I'm definitely going to progress this and see how we do, and I guess keep you updated in terms of how it goes. I consolidated all my pensions. For anyone who was super observant on terms of wealth early, you might have noticed there was, a pension, a PP next to one of my wife's pensions, which was a figure earlier in the year and is now 0. That was my wife's previous employer pension. So we've consolidated everything into Nutmeg and our current one. So a lot simpler, and reduced management fees as a result of the amount that we have in there. So that feels good. I also, again, touched on here when I mentioned my moves from my general investment account, where we were keeping an emergency fund in shares, which is never ideal long term, to be honest. But we're now basically building a cash pot in Virgin Money, and we have a Virgin Money account basically linked to our Clydesdale mortgage. And I'm formally offsetting. So for anyone who doesn't know, we have a mortgage amount and a savings amount. Those two figures offset each other. So I don't pay any tax on my savings because I don't receive any savings. Technically, it's a reduction, right? And then I only pay my mortgage on the percentage that it's netted off against each other. Now, what my wife and I have decided to do is overpay anyway. So we're basically paying the same amount, which works out about £300 a month. So we're basically paying what we would have done anyway. But we don't have to, but we're making really good progress on our mortgage as a result of that. And and it works out about £300 a month, but closer to £4 grand a year once we've rounded. I've actually spoken to 2 financial advisors this year. One of them was offered to me free of charge by Nutmeg. However, I found them a little bit underwhelming, to be honest. I also had a consult with somebody's financial advisor from Discord who was much more impressive. Yeah, really enjoyed the chat, to be honest, and may well, it was just a free consultation as well, which is excellent, but may well pay for her service in the future. She was actually one of the people who mentioned about EIS VCT, and again, I did look at these when I first started, but it wasn't appropriate for a number of reasons, but since then our situation has changed. I've become a bit more risk willing, as has my wife, interestingly, since she started working in VC, so I think it now makes sense to revisit that as a possibility. And yeah, just to round it up, I did remortgage and did an equity release. It doesn't really show in my numbers because a lot of the equity release, I did this to have some flexibility, and because at the time I was looking into going into business with my best friend. We're basically looking at doing 50 grand each plus, and basically buying a rental property from that perspective. However, it just, my partner decided that he didn't really want to do an equity release with the figures what they are. And that's fine. He's also got a very young daughter as well, so it just wasn't really good timing for him. It doesn't really cost me anything because, like I say, I just basically released it, but then put it back into a savings account. And so, technically speaking, I could show it differently, I suppose. Like I could add that 50 grand to my equity and show it as like, a different line. But I just basically park it for now because it's got nothing to do. But I do actually have 50 grand sitting in a savings account in Virgin Money rather than the 11 and a bit grand I have in a current account in Virgin Money. Both of them are offset, but the 11.5 grand shows, but the 50 grand doesn't. So again, I want to be like as transparent as possible. It's just a fairly arbitrary decision I took because, it's my data, my videos, etc. But yeah, so that's kind of how we're doing. There may be 1 or 2 things to add to this by the end of the year. But these are the 2 things I want to kind of understand and complete. And yeah, it's just basically a bit of an update. Again, I'm trying to do a few more videos. I've not really delved into wealth, although I sometimes touch on it in my portfolio updates. It doesn't feel sufficient. So I thought this would be good. Hopefully it's been interesting. And if you have any questions, comments, improvements maybe, let me know, and we'll try and do a bit more of this as well. Thank you very much for watching, everyone, and good luck with your wealth building. Bye for now.